Bolger here with this month's financial markets update. Well, financial markets continued their upward movement in April. In fact, we had a pretty strong rally right across the board, both in equities as well as in fixed income assets. Our local equity market was up roughly around about 3.5%. That was driven on the small cap side with that up roughly around about 5% from a market point of view. Global equities were similarly up roughly around about sort of 3 to 3.5% over the course of the month. And equally, we saw the rally in fixed income markets after a very difficult month of February where fixed income markets were sold off pretty significantly. We certainly saw some yield stabilisation with actually yields at the long end of the curve actually retracing slightly. And so we had a positive return for fixed income markets, both domestic and global, through the month of April. So, for the multi-sector portfolios, particularly sort of those all asset type portfolios, actually delivered another good solid result in the context of investment performance. When we look at particularly fixed income markets, and certainly the retracement we've seen through March as well as obviously through April, we do believe that's really just reflective of a little bit of a catch up on the back of the sell-off that we saw in February. Our core view still remains that we expect bond yields to move higher throughout the course of 2021 on improving global economic activity and the growth outlook, as well as the likelihood that we're starting to see some rises of inflationary expectations pushed through the system. The most notable of those, I think, through the course of April was really in timber prices, not only domestically but certainly in the US. Housing has clearly been on the rise over the last 12 months particularly, and that's resulted in not only some of the challenges in terms of supply chain logistics, but equally just that sheer demand has seen timber prices move up to all-time highs. So that's now starting to flow through in terms of some of the inflationary elements we're actually seeing right across the market environment. We do think it'll be moderated, but from our perspective, when we look at some of the challenges around migration, some of the challenges around employment growth, and obviously the demand that we're now starting to see in certain sectors of the market, we do think that inflationary expectations will start to tip up a little bit over the next 3 to 6 months. And I said the balance of that's really going to be predicated on the speed of the vaccination program, the ability of the vaccination program to allow for reopening of not only the domestic but the global economy in the context of what that means for inflationary expectations through the second half of this year. But all in all, as I said, we're not envisaging that inflation is going to move significantly above central bank target levels. And in fact, if we look at it on a number of metrics, we're still well below the 2% as the sort of the minimum of that 2 to 3% range bound that central banks such as the RBA and US Federal Reserve have on their radar before they start to think about shifting on the rate cycle. But what was a couple of key drivers for market performance throughout April, and we really don't have far to look, but the commodity markets continue to move significantly higher. Broad-based Bloomberg Commodity Index was up over 8% in April alone, driven by higher prices that we saw through nickel and copper particularly, but equally iron ore, which has now reached an all-time high throughout the course of April into early May. So we've really started to see that demand for industrial cyclical-based metals, as I said, continue to be aggressively bid up. And then it's one of the key reasons why I've been maintaining and increasing our positions in particularly copper, iron ore and nickel within our portfolios. Not only do they form the basis of that industrial metal, but equally they're being used in renewable energy such as wind turbines as well as EVs, and certainly we see the demand for, as I said, renewable energy type products only continuing, and that's going to benefit, as I said, particularly things like copper and nickel on that front. As we look across portfolios, we really haven't made too many changes in regards to our asset allocation positioning. Again, as we've spoken about on previous occasions, we remain fundamentally constructive on the outlook for growth assets, noting that there may be some challenges through the second half of this year if inflation picks up at a quicker rate than what central banks are anticipating, and that may require a change in the way that they're thinking about interest rate policy, and that may have a slight flow-on effect in terms of equity market performance and valuations. As we sit here today, we still believe that certainly the Australian market doesn't look overly stretched. We'd probably say that certainly in the upper ranges of our fair value metrics. Global equity markets do look like they're trading on a slightly higher valuation, but when we look at sort of some of the growth optionality that could come through, particularly in, say, in Europe, we think that there is some good opportunities still in global equities. But we are balancing out, as we've spoken about previously, our equity exposure with a number of growth alternatives, just providing that longer duration framework, as well as obviously trying to provide a dampening impact just in terms of that day-to-day volatility that we see in equity markets. So overall, April was a really strong month for financial markets. We're starting again to see that continue through the early parts of May. Again, we're starting that recovery theme, that growth theme is really driving that in many instances. And really the only negative that we see on the horizon in the short term is that if inflationary expectations speed up at a quicker rate than what markets are anticipating, that may require, as I said, some changes to interest rate policy, and that may also then start to flow into the performance of equity markets over that period. But in our view, as we sit here today, as I said, we don't see any changes to the way that we are thinking from a strategy point of view at this stage. As I said, we think inflation is relatively well contained in a broad context. Our underweight position in fixed income is being maintained. As I said, we still think that we'll start to see high yields throughout the course of 2021. But as I said, April was a very pleasing month in terms of broad financial market performance, given that all sectors delivered a positive return, and we continue to see sort of a cyclical recovery coming through, and we're certainly playing that both in terms of our multi-asset as well as our direct equity portfolios. As always, if you have any queries about other portfolios, please feel free to reach out to anyone in the team, and we'll catch up again next month. Thanks, and bye for now.